The Fed's decision to continue the $85 billion buying bond program a month has sparked an immediate drop in mortgage rates yesterday. Will it also spark another spurt of home buying? Diana Olick on that. Over to you, Diana.
Well, Maria, you're right. Rates dropped pretty dramatically after the Fed tabled the taper yesterday. But let's take a look at first where we were before that. The 30-year fixed about 4.80% for the conforming loan. That on the Mortgage Bankers Association read last week. Since May, rates are up well over a full percentage point, which translates into about 20% less purchasing power for the average home buyer. So where are we today? Well, of course, it depends on what lender you're going to. But 4.25% is a real possibility today. You're going to have to pay points, of course. The range seems to be between 4.35% and 4.5% if you have good credit and if you have a large down payment. This according to Mortgage News Daily. Interesting, though, the realtors say that rates will not help the housing recovery going into fall. They say that August was, in fact, the last hurrah. Why? Well, sales were up 1.7%, but they say that this was buyers jumping off the fence, buying a home because they were afraid of rising rates. So where will rates go from here? Well, the answer to be determined, of course, but we know they could go a little bit lower for now, but they will likely start rising again, especially as we head towards that next important jobs report. Maria?
All right, Diana, thanks very much. We've got more reaction right now with Fred Glick, president of U.S. Loans Mortgage and a real estate agent and mortgage broker, and David Licken, managing partner with Mortgage Banking Solutions. Gentlemen, good to see you. Thanks very much for joining us. David, is the decline in rates after the Fed decided not to taper going to be enough motivation to get those buyers back into the market? What do you think? Is that enough?
It should be. You look at where rates, a lot of people were just, were procrastinating and not taking advantage of the lower rates. This is their opportunity. But I think the uncertainty in the market's still out there, and it depends on which market. It'll be a regionalized reaction, Maria, is what I'm predicting. You're going to see those markets where there's still a lot of inventory to work through. They're not going to be as motivated as the markets where there has been a shrinkage of inventory like we have here in parts of Texas, specifically here in Austin, Texas. You're going to see people wanting to get into it. And so it's going to be an Indian summer, so to speak, on the real estate markets. But I agree with that one report. It's going to be short-lived because we got higher rates ahead.
Yeah. Fred, why do you see the Fed's non-move as a double-edged sword?
Well, basically, we're going to see interest rates come down a little. And I kind of disagree with Dave. I think we're going to see lower interest rates for a long time because the other side of the story is that the jobs aren't coming back. We still have high unemployment. We still now have, with this non-taper, a situation where people say, well, maybe the job market isn't as good as I thought. Maybe I won't keep my job. And it's all about, I'm going to keep my job. I'm going to plant roots. But that's not the case anymore, possibly.
We've seen a number of banks lay off mortgage division employees. Refinances have slowed. We know that. Did they bet wrong on the Fed, David, and a possible revival of refis and purchases?
They did. A lot of people were anticipating, and it was priced into the market, therefore the recovery that you saw, the fall in interest rate. It was priced in the market that we're going to anticipate tapering. So, yes, everyone's talking about the refinance applications dropping off. Purchase applications are there. I love Fred's optimism about interest rates are going to stay low forever. But look at the unemployment or the jobless claims today. Look at the new housing numbers, existing home sales that came in stronger. Each one of those numbers, as they continue to come in stronger, are going to put more pressure. And you know what? The Feds are monitoring one aspect of it, foreign policy, what happens in Syria, what happens with Fannie Mae and Freddie Mac. All those things are in play here and are going to have a very tenuous, create continued uncertainty is what I'm anticipating.
You said a minute ago rates are going higher. How does this play out? What's your expectation? How high do mortgage rates go in the next year?
Well, I think you're going to see interest rates climb as much as a full point. I don't think the market can go much further than that, but I think that's a worst-case scenario. I think an optimistic scenario is we're going to hang in the high fours through the rest of this year, possibly through first quarter, and then we can see interest rates go up into the fives. It all is going to be determined upon what we see in economic data. A Fed's saying they're monitoring. They didn't say they're taking the hands off, we're going to be here forever. They're saying they're closely monitoring it. So they restated what they brought clarity and consistency to their commentary, and we're going to still just monitor those economic reports that you guys cover so well each and every day.
Yeah, and what's the impact of that, Fred? What do you think? Do you agree with that, and what would you say the implications are?
I again think that we're on this nice plateau of jobs. I've said this a million times. There's no it to make us just appear to have to hire tons and tons of people in this country. And we're turning into a giant service industry servicing ourselves. So the problem is the creation of jobs. Period, done, end of sentence. And the chairman even said until they get below, I think it was 6.5%, they're not going to go anywhere. So they're going to keep buying and buying and buying. They're going to keep buying mortgage-backed securities. They're going to keep the rates low. And I think this is going to be for a long time. I mean, there was no one like screaming at me, calling me, oh my God, I have to refi yesterday, or I have to buy yesterday, even though rates went down 1/4 point in rate. It's just not there. The comfort factor isn't there. It's nothing you can measure in a statistic.
All right, we'll leave it there, gentlemen.
Okay,
great conversation. We appreciate it. We'll see you soon.
Thank you, Maria.
Thanks. Up next,
And
the
Dave.
global outrage against Syrian President Assad has not changed his standing.